Today we are focusing on the excess business loss limitation for individuals governed by Internal Revenue Code Section 461L. For the 2025 tax year, the exam will expect you to know the inflation-adjusted thresholds that limit the amount of net business losses a non-corporate taxpayer can deduct. This amount is $305,000 for a single individual and $610,000 for a married couple filing a joint return. Any business loss that exceeds these thresholds is considered an excess business loss. The key exam point is not what happens to the loss that is allowed, but what happens to the excess that is disallowed. It is not lost forever. Instead, it is carried forward to the following tax year and treated as a net operating loss, or NOL. This means it will be subject to the NOL deduction rules in that future year, such as the 80% of taxable income limitation. Let's walk through an exam-style scenario. Imagine a single taxpayer, Maria, who is a material participant in a consulting business reported on Schedule C. In 2025, her business generates a loss of $400,000. She has no other business income or losses. The exam will ask you to calculate her excess business loss. You take her total business loss of $400,000 and subtract her single filer threshold of $305,000. This results in an excess business loss of $95,000. Maria can deduct $305,000 of her business loss against her other non-business income, but the remaining $95,000 is disallowed for 2025. This $95,000 is then carried forward as an NOL. A very common exam trap involves the order of operations for loss limitations. The excess business loss limitation is the last one you apply. A question might give you a scenario involving a partner in a business with a large loss, insufficient basis, and no at-risk amount. You must first apply the basis limitations, then the at-risk rules under Section 465, and then the passive activity loss rules under Section 469. Only after applying these three limitations do you calculate the excess business loss limitation. A good mnemonic to remember the order is basis, at-risk, passive, then excess. Another trick is how the exam defines a trade or business for this rule. It includes activities from Schedule C, Schedule F, and pass-through entities like partnerships and S-corporations. It does not include investment income or loss. So, if a question includes a large capital loss from selling stocks, you must ignore it when calculating the net business loss for this limitation. The calculation itself is reported on Form 461, Limitation on Business Losses. Be prepared to identify this form. Let's consider a married couple filing jointly. They own two businesses. Business A has a loss of $700,000, and Business B has a gain of $50,000. First, you net these amounts. Their aggregate business loss is $650,000. Their joint threshold is $610,000. The excess business loss is the amount over the threshold, which is $40,000. This $40,000 is disallowed and becomes an NOL carryforward. Remember the rule for the excess. It's not lost, it's just tossed to the next year as an NOL. This is the critical takeaway.